Hey everyone, all one of you. Okay, so I'm going to start with a little thing on risks, on all the different risks, and then we're going to see where it goes. And if it goes short, it goes short. So first of all, let's talk about the different risks. So let's talk about common stock. So if you buy common stock, which is the regular stock, one of my students says, common stock has the risk that the stock will go down. What causes it to go down? Many factors, but we have business risk or what they call non-systemic risk. Non-systemic risk is the risk that the security will go down because of its own problems, like its business, like Elon Musk says something, or something happens with the actual company. That's business or non-systemic. How do you get rid of that? By diversifying. You can diversify that away, and that's what gives you, you can get rid of non-systemic risk that way. Okay. Lloyd, that's awesome. I'm so happy to hear that. So I'm so happy to hear that. I'm sure it sounds like there was a lot of risk questions, which is what I'm trying to push a little bit, and then the regs. But I'm so happy for you. Let me know when I'm done with this, when you're taking the top off, either the 7 or the 6. But I'm happy for you. It's a great feeling to get through this, right? So the other risk is systemic risk. Systemic risk is the risk that the whole market crashes, that you can't control that. You cannot diversify that away. Like on I think December 24th, everything was down huge, or even 2 weeks ago, the market was down 800 points. Even if you had a company that was doing fabulous, making money, printing money, if the market went down, you went down with it. There's nothing you can do about it. You cannot diversify away market or systemic risk. So common stock pretty much has systemic, which is market risk, and then non-systemic, which is business risk, like the security on its own goes down. You can diversify non-systemic risk by buying other securities, or even just investing in a mutual fund, variable annuity, ETF, stuff like that, closed-end fund. Systemic risk, the only way to really get rid of it is to chicken out and not be in the market, but then you lose to inflation. The better way is maybe you buy index options, maybe you buy some index puts. So even if the market goes down, the money you lose on the portfolio, you'll make on the call, on the put. Okay, now let's talk about other risks. Okay, let's talk about a couple other things. Hey, Robin, how are you? Glad to see you on board. Let's talk about bonds. So debt. Debt is basically you lend me money, I'm going to pay you back over time. So some of our biggest risks are credit risk. That's always the biggest one. Credit or default risk, the fact that I won't have enough money to pay you. Okay, how do we measure that? Well, we can have an analyst look at it, or what we do, this cough is going to be annoying to you and me. How do we measure that? We look at the credit ratings, AAA, AA, A, triple B, that's investment grade. Anything below triple B is speculative. AAA, AA, triple B is the bottom. If you went to Moody's, it's A, little a, little a, little a, and then BAA. That's BAA is the equivalent of BBB. That's Moody's. And then below that will be BA. That's how we measure credit risk. Now, again, credit risk is a risk that we won't get paid. That's the biggest one. Another risk we have is interest rate risk. What's interest rate risk? Interest rate risk is the risk that rates will rise and the price of your bond will not be attractive anymore. Because remember, if you buy a 5% bond, it pays 5% every year, no matter what. So if rates go to 7, it's still paying 5. So everyone else is doing better anyway. New bonds will be doing better than yours, so the price will drop. Okay. Now, if interest rates go up, prices go down. Hey, Dave, how are you? So now, interest rates go up, price goes down. The bonds that have the most interest rate risk are long-term bonds. Long-term bonds. Then we have low coupon. Remember, as I tell my students, long and low, baby, long and low. Long-term bonds, low coupon, low price, they're the most volatile of all of them. Now, if I could get a mic to get rid of that little cough thing, it'd be great. But, so now we have interest rate risk, we have default risk. We also have inflation risk. So over time, long-term bonds have a lot of inflation risk. As prices of goods, not prices of bonds, prices of goods rise, your bond's still paying the same amount of money, so you have inflation risk, or what they call purchasing power risk. Inflation or purchasing power risk is the risk of a bond or any fixed income, even a preferred, that over time, your money that you're getting every week or every 6 months or every year is not worth as much. Now, the other risks we have are call risks. So if interest rates drop, the issuer is going to go, wait, I don't want to pay this high coupon anymore, so they're going to buy it back. That's call risk. Call risk is the risk that they're going to buy back the bonds from you. You're going to buy back the bonds, and then you all of a sudden have this money back, and you have, well, what are you going to do with it? You're going to reinvest it at a lower rate because that's all that's available. So now we have credit risk, interest rate risk, inflation risk, call risk. The other risk is reinvestment risk. Only coupon bonds have reinvestment risk. Only, yeah, coupon never changes. Exactly, Lloyd, geez. If you have a coupon and you're getting 8% a year, and interest rates drop to like 4, you're still getting 8. But what are you going to do with that money? You're going to reinvest it, and it's going to be at that lower rate. So that's where the problem is that reinvestment risk is as you're getting paid, it's going to earn, as you reinvest it, it's going to earn less money. Those are some of the main risks. We have other risks. If you invest in a muni bond, since it's tax-free, there's a worry that they're going to change the tax code. That's legislative risk. If you invest in a tech or a biotech or some sort of medical thing, they might make rules. They might make a ruling on whether your drug or whatever works. That's regulatory risk. Also, if you buy ADRs, an ADR is a foreign security trading in the U.S. A foreign security trading here. There's more to it, but it's basically a foreign security packaged, and then the package trades here. But you have all the risks. You have systemic and non-systemic because it's a company. And then you also have political risk because we don't know what's going to go on over there. And we have currency risk. Even though the ADR pays in US dollars, the foreign country doesn't, so they have to convert, and the bank will rip you off and then do it. That's currency risk. So ADRs have systemic, non-systemic, political, and currency risk. So hopefully their return is a little bit better because it's more risk. Okay, we have opportunity risk. Opportunity, or technically timing risk. Opportunity risk is the risk that you invest in this when you could have invested in this, and this does better than that. That's it. There's no way to avoid that. It's just basically I'm born with that. Timing risk is just buying it at the wrong time. Oh, I bought at the high and I sell at the low. Everything is timing risk. Everything is opportunity risk. Okay, those are the big risks. So we got on bonds, credit risk, interest rate risk, inflation risk, reinvestment risk, call risk. That's just non-callable. Now, how would I protect against interest rate risk on a bond? I would buy interest rate or yield-based calls. So if I buy interest rate calls, the money I lose as interest rates go up and the bond goes down, I'll make on the calls. Okay, that was my 9-minute diatribe on risks. Boom. So call protection is, Lloyd, you're right. So call protection is going to be the fact that I'll get to it in a second, Robin. That basically the number of years that the issuer cannot call the bond back. So if I buy a 10% bond, I am worried that interest rates will drop and they'll call it. So what they will do is they will put a 10-year call protection on it, so it can't be called for the first 10 years. I like that. Okay, so Robin, I'm confused by the 50% minimum, 50% minimum requirement, and the $2,000 minimum requirement. Okay. Okay. Lloyd, I'm going to click on this. Most effective when yields are dropping, not when they're already low. Call protection is best when the yields are dropping, not when they're already low. Because if I have a low coupon already, I don't care if I don't have as much call risk. So on margin. So when you buy stock for the first time, they have a 50% requirement. That's Reg T. That's Reg T, not FINRA. That's the Federal Reserve Board under Reg T of the Act of 34. It says whenever you buy stock, you have to, or a stock on margin, you have to deposit 50% at a minimum. So what happens is, if you buy $20,000 worth of stock, you put down 10 grand. But now what happens if I buy $3,000 worth of stock? Well, normally it would be $1,500. But I got that $2,000 minimum. So I'd have to put down 2 grand. So again, if I buy over $4,000 worth of stock, good, Lloyd. If I buy over $4,000 worth of stock, I only have to put down 50%. If I buy 4,500, 2,250, I buy 8,000, I put down 4 grand, all that. But if I were to buy $3,000 worth of stock, yes, 50% is 1,500, but that's lower than my hard floor of 2,000. Now, a couple quick things on that. If you're shorting stock, and if you want to know what shorting stock is, I have other videos. Shorting stock, it is always 2 grand no matter what, at a minimum. So if you short 1,500, you put down 2 grand. You short 4 grand, you put down 2 grand. If you short 8 grand, you put down 4. So it'll never be lower than 2. The reason I say that is that if you were to buy $3,000 worth of stock, you put down 2 grand, buy. If you were to buy 1,500, then you only have to put down the 100%, the 1,500. That's all you would have to do. Because the most you could lose when you buy stock is what you paid. So they'll never make you put down more than you can lose. Okay? Stefan, that's awesome. Now, again, I hope that helps, Robin. So if I buy $3,000 worth of stock, I put down 2 grand. If I buy 5, I put down 2,500. If I buy less than 2 grand, I just put down what I have to buy. I'm happy to hear that, Robin. Okay. Opening sale and closing purchase. Okay, so let's start with this. Whenever you create a position, whenever you have created a position, it's an opening transaction. So if I buy a call or buy a put, that's opening. How do I get rid of that? Somebody tell me, if I buy an option for the first time, that's an opening purchase. How do I get rid of that option? I could exercise it, but how do I do it? I have to sell the option. So now I'm selling it to close out my position. So opening purchase is when you buy it for the first time, and a closing sale is when I get rid of it. Opening purchase, closing sale. Now let's say I write a call for the first time. That's an opening sale. Whenever I do something for the first time, that's opening. How do I get rid of it? I buy it back. That's a closing purchase. So if I have an opening buy, I follow by a closing sale. If I have an opening sale, I follow it with a closing buy. I hope that helps. Dave. Okay, if it doesn't, ask me a question. Maybe I can fix on that. Now, who has the best material for the Series 7? The top off, that's up in the air, but I still think right now STC has the lead. Training Consultants is pretty good. Top off at the STC is good. Kaplan and Notman are okay. They have good supplements. Notman has really good supplements. The only problem is that their questions don't look like the exam. I mean, neither does STC that much, but they're closer. For right now, I think it's still STC in the lead. Pest Perfect is not horrible. Pest Perfect, what they do is that they go a little, because it looks like I lost a bunch of my viewers. Can you guys hear me? Looks like I'm back to being stable. I was unstable, now I'm back. Okay. So, STC book, if you think videos help, get the videos. That's totally cool, okay? Now, Robin, you're taking the Kaplan 3-day crash course tomorrow. What are your thoughts? I think it's fine. It depends on who the teacher you get. I think if you can pay attention and not worry about the option stuff too much, because if you're taking the SIE, they might, I think it's the SIE that you're taking. Okay. So I'm going to repeat this again. So Past Perfect is good, but they are very, they're a little too mathy. That's all. They have a lot of math, a lot of problems, but they're solid. You'll be ready. So now, Robin, I'll go back to this. So the Kaplan 3-day course is fine. It's actually good because a lot of the other ones are only doing like 2-day courses, which is tough. Just take it with a grain of salt. Try to get down the regs. Make sure you get the regs and the risks. And heck, ask a lot of questions. Bug them. If they don't know their stuff, you got to put them on the spot. Because I don't love when they interrupt every 10 seconds, but sometimes they ask questions that are challenge me, and it's good. It's good to learn, and I never get it wrong because I know my stuff. But it makes me work a little bit. Okay, so Jake, can you go over an easy way to remember dates of paperwork, annual, semi-annual, monthly, such as statements? Okay, so there's not a lot on this. It's more about reading, but think of it this way. Statements go monthly. Basically, their statements are going to be issued monthly unless they have no activity. If there's no activity for, I think, for the last 18 months, if there's no activity in the account, then you can do it quarterly. But if they have penny stocks or activity, it's every month. Penny stocks, activity, monthly statements. If it's no activity, it's quarterly. That's just the way you got to think about it. You do have to upcheck everyone's customer account paperwork every 3 years just to update it. Not a lot of annual stuff. So Renan, is it Renan? Sorry about that. Yeah, I'm so happy for you. I'm happy you passed. What's next? The top off 6 or the top off 7? If it's the 6, it's not easier than the SIE. It's just less things. If the top off, it's a lot of risks and a lot of suitability and a lot of options, and a lot of munis and a lot of taxes. Okay. Anything else, you guys? I think I covered most of the risks. I can probably look up. See, let's see. So at legislative, regulatory, I covered a lot of the risks. I can talk a little bit about variable annuities. I'm not going to go super long on it because that's more of a top-off thing, and happy to come see me if you want to do top-off stuff. Variable annuities are a non-qualified retirement plan, okay? Non-qualified retirement plan. And the money goes in after tax. It grows tax deferred, and then when you withdraw it, you have to be 59.5. But if you do the annuity where they pay you for life, you can do that at any age. And as you go along, each payment is partially taxable. So again, variable annuity is a security. You have market risk. You have it grows tax deferred. So as it's growing, you pay no taxes, but it goes in after tax. So the money you put in is after tax money. Okay, keep that in mind. It's after tax money. Okay, so let's keep moving on this. Now, variable annuity goes in after tax. It grows tax deferred. You get paid out. You're going to pay tax on the growth portion. So if you take the withdrawal, you'll pay tax on the growth. If you get a monthly income from it forever until you die, then each payment is partially taxable, partially not. Okay, Robin. Okay, so you are taking it in what? Less than 8 days. Okay. So after you do the crash, yeah, you should be doing the crash course. I think it'll help. The crash course will absolutely help. Okay. It's more information. More information is always good, especially this. The regs, they can just give you some stuff. They may just give you little tricks. Like the Active 33 is for primary. The Active 34 is for secondary, stuff like that. Active 39 is for corporate bonds. Active 40 is for either investment advisors or mutual funds. They just give you stuff like that. You'll learn the AML stuff. If they spend a lot of time on options, I mean, try to just work on other stuff because they may spend hours on it, and it's kind of a waste because you're going to get maybe 2 questions. If you're taking the top off after, then you need to know them. Like when I teach my students for the SIE, I do go farther than they need to so that it makes the top off studying a little easier. Unless you're taking the 6, and then I kind of don't, I barely touch options other than with the videos and stuff like that. Okay, underwriting. So Jake, you mentioned underwriting, so let's talk about that for a quick second. So, okay, so awesome, Robin. Don't worry about options too much. Just know the basics, like the buy call is right to buy. I think I did a couple, and there's a million videos on YouTube about options that I'm not going to waste time with. So if you can get the basics on options, you're good, and then the 6 shouldn't be all that bad. Okay, underwriting is when they're help bringing a company public. So there's different types. So if I'm an underwriter and I'm going to help you come public, I have a couple things that that I can do. So if I could do if I'm an underwriter, I might just firmly commit that I'm going to help. Thank you, Robin. I'm going to help sell your shares. So a firm commitment is I'm an underwriter. You want to issue 1 million shares? I'm guaranteeing it, which means if I don't sell those shares, I'm going to buy them for you. That's firm commitment. And the risk is on the underwriter, because if I can't sell them, they're on me. Best efforts is I'm going to do the best I can. And if I can't sell them, I give them back to you. That's the best efforts, and the risk is on the issuer on that one. Now, there's a couple little mini ones in best efforts, like a mini max, where I go, look, I want 1 million, but if you get 600,000, we're a go. But if you don't get the 600 grand, that minimum, I want to cancel the deal. But I want 1 million, but if you get 600 or 700 grand, we're a go. Then there's all or none, which is basically you sell all of it or you sell none. All or none is also a type of order on the market, but this is about underwriting, so it's going to be that way. So we're going to have an underwriting where I do 1 million, and if I sell 900,000, you cancel the deal and everyone gets their money back, and the shares go back to the issuer. So again, the risk is on the issuer on that one. Okay. So the other one is with a rights offering, a standby underwriting. A standby underwriting is when I'm going to issue additional shares. So I give all my current shareholders rights to buy shares. What can they do with it? They can exercise it. They can let it expire. They can trade it. They can gift it. They can't redeem it back. So any rights that are unexercised, what's going to happen is the standby underwriter will stand on the sideline and buy all the shares and then sell them to the public. So this way the issuer doesn't have any risk. Okay, I did a lot of talking. 23 minutes of talking, even after teaching since 10 o'clock this morning. I'm going to pat myself on the back there. Okay, so any other questions before I head out? Again, Robin, keep reading. Get the customer account stuff done and get the risks. Go over my risk videos and this one. Okay. No problem, Jake. Keep at it. Okay. I'm glad, Dave. I'm hoping I help you out. I'm really trying to do it. My big thing is I was really upset the last 3 days because usually my viewerships are going up and my subscription, and they kind of died. So please tell people, share it with people. It makes me feel good. I have a very soft heart, and I cry at night when I don't get this. Dave, you can reach me if you look for me on LinkedIn, Kenneth Finnan. Yeah, that's probably what it is. Everyone's on vacation, but I got all these analysts coming in. I have so many students, so that makes me feel good. I'm still paying my bills, but yeah, that's probably what it is. Good, make me feel better that it's not the lack of love for me. Dave, if you look for me on LinkedIn, Kenneth Finnan, there's not many of us. You should be able to find me, and I think I have my phone number on there. Make you do a little work. And if you can't, just shoot me a message on here, and I'll try to throw my number on there somewhere. Listen, guys, everyone have a good Sunday night. The rain just stopped, so I can actually go outside. And keep at this. Keep reading. Don't stop. Just keep reading. Don't just focus on questions. And anyone, Jake, if you want to ask me a couple questions, go for it. And Robin, if you have a couple questions, I'm not in a super rush. I have another 15 minutes before I have to go pick up my daughter, who is due in the next 72 to 96 hours, I think. Yeah, I look way too young to be a grandfather. I know that. Okay. Jake, hit me with a couple questions real quick if they're not super detailed. If not, we can do another session. Robin, I think I'm going to try to do another live on Wednesday. Okay. What all is purchased on margin? So, okay, anything can be purchased on margin. It's easier to say what can't be purchased on margin. So, mutual funds can't be purchased on margin. Options cannot be purchased on margin. If you're shorting an option, it can only be done in a margin account, but you can't buy it on margin. You have to put down 100%. Okay. Okay. Perfect. I'll see what I can do. Okay. I'll try to do Wednesday. Oh, it might have to be Tuesday because I'm dropping my daughter at school on Wednesday. I might have to do Tuesday night, but it's got to be later. So if you guys on the East Coast, you better stay up. If I can do it during the day, I might, but I get no traction during the day because everyone has a job. Okay. So again, where was your question? Okay. Margin, it's easier to know it's not on margin. It's going to be mutual funds, anything redeemable. You can't buy variable annuities, no options. no mutual funds. Anything else can be on margin, but if it's an exempt security, like a treasury or a muni, it can still be bought on margin, but it's not FINRA that's, it's not Reg T that controls it, it's FINRA, because Reg T is only for non-exempt securities. Okay, any more? Yeah, no, that's true. Good point. You cannot do custodian accounts in a margin account. And they can't be in street name, which means it has to be in the kid's name. Which also means SIPC doesn't apply, because SIPC only applies to street name. SIPC, it's the insurance in case your broker-dealer fails. They cover up to $500,000 in securities, of which $250 can be cash, but only for street name, because if you have it in your own name, you don't actually give a crap if the broker-dealer goes bankrupt because you have the shares. Street name, it's in the broker-dealer's name, and if they go bankrupt, you're like, wait, where's my shares? So SIPC comes in and helps out. So if you have more than $500,000, God bless you if you do. If you have more than $500,000 in a brokerage account in one broker, well, you're taking a risk that if they go out of business, you're losing anything over 500 grand. Okie doke. That was a good half hour. Not bad. I kept talking. I like to get back and forth. The last couple weren't so great because no love, baby. Okay, you all have a good night. If anyone wants a lesson, reach out to me on LinkedIn. And Dave, it'll probably be Tuesday, because Wednesday I'm dropping my kid off, and it's going to be like Tuesday 9:30 or so. I can't. I'll be on a train, and Amtrak would absolutely freaking kill me if I spend a half hour doing this. I mean, maybe I can try it, but I don't have enough viewers to do live on my phone. They won't let me do it. I need another 400 viewers. So get me viewers. Okay. You all have a good night, and I will get Jake reach out to me. Anyone who wants to meet with me, reach out to me, and we'll go from there. I will talk to you all later. Have a good night. Keep reading. Get those risks down and get the regs. Awesome. Have a great night, guys. Jake, thank you very much.